Profit with chart patterns, broadening bottom. A declining price trend precedes a broadening bottom. Even if prices rise just before the formation begins, ignore it. It is still a bottom. This arbitrary designation also makes intuitive sense. A bottom should appear at the end of a downtrend, not when prices are climbing to the moon. The shape of the formation is distinct. It looks more like chaos theory where small disturbances oscillate back and forth, then sometimes grow unbounded, wreaking havoc. In the stock market, prices reach new highs, then cross over and make new lows. When you draw a trend line across the minor highs and another connecting the minor lows, the formation looks like a megaphone. The two trend lines drawn across the minor highs and lows are important. The top trend line should slope up, the bottom one should slope down. The diverging trend lines distinguish the broadening bottom from other types of formations, such as the right-angled broadening formation, which has one horizontal trend line, or the broadening wedge. Both trend lines slope in the same direction. So it is important that both trend lines have a slope that is opposite each other, that is, the top slopes up and the bottom slopes down. A broadening bottom needs at least two minor highs and two minor lows to be a valid formation. Anything fewer means you are incorrectly identifying the formation. What is a minor high or low? A minor high is when prices trend up, then drop back down, leaving a clearly defined peak. A minor low is just the same thing flipped upside down. Prices move lower, the head back up, leaving a clearly defined valley. As long as you can count at least two peaks and two valleys, wherever they may appear, that is fine. When price head up, so does the volume, and when price heads down, so do the volume. The volume can be irregular, so the volume trend is a general guideline often broken. When selecting a broadening bottom, ignore the volume pattern. The breakout point is difficult to identify in a broadening formation as it is developing. In retrospect, it is easier. Look for the place where prices pierce the up or down trend line or make an extended move. If prices pierce the trend line, then the penetration point becomes the breakout point. If prices move up and follow along the top trend line without piercing it, then backtrack to the prior minor high and draw a horizontal line forward in time until prices cross it. When that happens, that is the breakout point.